as we start off 2025, and it really hasn't even begun yet. January is still very much affected by volume coming in very slowly. Definitely waiting on the non-farm payroll released this Friday at 8:30 a.m. Eastern. A huge macroeconomic marker because it's one of the two mandates that the Federal Reserve has, inflation and of course unemployment. We saw what the unemployment number, the JOLTS number, did today when it came in better than expected. So yes, we are back in that environment of good news is bearish and bad news is bullish, right? Anytime we're waiting for data to put the pressure on the Federal Reserve to remain accommodative, we need bad news. And that's where we sit going into Thursday's bank holiday. What we want to do at this point in the year is find our true north, find those principles that if we can stick to them, and I don't mean 100%, gang, no one sticks to their discipline 100%, nobody, right? But if we know what ideal is, we know what those principles are, we have a chance. Even if we can stick to them 70, 80%, heck, even half the time, we've got a chance to continue to grow our accounts. So I'm going to talk about a few things here. The top three, swing trading, and this is limited to swing trading, although you'll notice it probably applies to any kind of trading that we do. Some of the common sense rules, why what I trade is more important than how I trade it. We're going to talk about optimizing for slowness, as well as metrics that do and don't matter. So let's get to it. This video hopefully will serve as a touchstone whenever you find yourself wandering into the tall grass and watch this video again, come back to not just what we need to do in 2025. This will work in 2026 as it has in 2024, right? And as we go through this month, I'm going to continue to share with you all a look back quarter by quarter. And then ultimately in a webinar, likely early February, where we take a look back at the entire year and some of the tools and tactics that I use. But, week to week, I'm going to show you all what we did. This is Q1. Don't be impressed with Q1. Q1 went straight up, all right? But yes, when the market was going straight up, we did really well. This goes to show when you have an edge, and an uptrend is an edge for just about every sort of trader, we want to press that edge. So let's get to it. We are dealing with indices that are choppy at best, bearish at worst. We're dealing with a Federal Reserve that's very non-committal about future rate cuts. In fact, at best, we're going to see one, if not two more quarter point cuts. This is not predictive. This is the data of the Fed Fund futures showing that it's very likely we will be 1 quarter point or 2 quarter point cuts lower than we are right now a year from now, right? That's what the data shows. How can we trade an environment that's likely going to be kind of tricky? We don't know what the tariffs are going to bring. We don't know what the new administration is going to bring. We don't know what maybe no more cuts or maybe 1 more quarter point cut and hold might bring, right? There's a lot of things out there that are uncertain. So this is how we find certainty. All right, gang, now and forever. I trade in a cash account. It's the easiest way to avoid the pattern day trading rule, or PDT, period. There's other kinds of acrobatics traders can do, but this is the easiest way for day trading and for swing trading, avoiding the pattern day trading rule, which would limit most traders to 3 trades of any kind over the course of 5 trading days. That's really difficult to deal with. If you're in a margin account that's under 25,000, you're subjected to the pattern day trading rule. You're trading with one arm tied behind your back and a patch over one eye. It's tough. All right. If I'm in a cash account, I'm going to buy long calls and long puts. When I share the trades with you all throughout this month, these are all long calls or long puts. No selling a premium, no multi-leg strategies. If I'm bullish, I buy calls. If I'm bearish, I buy puts. By the way, last year, I'd say 95% of the trades were long calls. All right. So then let's get to where a lot of traders get into trouble. And this is the heart of the Sector Secrets Mastery, gang. What I trade is more important than how I trade it. The strategy that most traders will use in an uptrend. Think about what we saw in the S&P and the NASDAQ for so much of last year. If I just stuck with the long side and I'm a momentum trader, I'm fine. I stick with the long side and I'm a buy the dip trader, I'm fine, right? And just about every kind of style in between, as long as the trend is the first thing that is respected. We want to get long because the overall direction is up. That's watch list building, gang. Here's a bad example of watch list building. There were a number of sectors that just couldn't get out of their own way last year. Playing a long position in say, the healthcare sector, playing consistent long positions in, say, Johnson & Johnson would have been very tough, except for a very small number of months here and there where the individual stock got bullish, right? Also, another thing that hurts traders is not being fluid with their watch list. Being bullish NVIDIA for about the first half of the year was a beautiful ride. Being bullish NVIDIA from, say, mid-September into November was pretty good. But there are periods of time where NVIDIA is not behaving, and now would be a really good time to say, yeah, you know what? NVIDIA is not an outperformer. Contrast that with Google, right? Google looked really good for a period of time. It looked really ugly for a period of time. And then now, since the Willow announcement, it's been pretty darn good again. We have to be fluid with what we trade. Uptrends are the best market to trade for the vast majority of traders. And here I'm going to go out a little bit on a limb because this is what we do in the Sector Secrets Mastery. The risk to reward is better in pullback entries than breakout entries. Right? Both participants, both types of traders can be long, but those pullback entries are going to be better. All right. Another thing that might seem very counterintuitive in a world of hotkeys and speed and high frequency and whatever else, optimize for slowness. All right. Couple basic guidelines for my swing traders out there. Wait an hour before putting on a swing trade. Let the initial balance complete. Get past the opening range or the clearing range. It's okay to wait. Right? Chasing FOMO speed is not going to get most traders where they want to go. In a world that embraces speed, go the other way, slow things down, be methodical, be patient. All right? Prioritize daily charts. That's another way to optimize for slowness. What's another way of thinking slowness? Steadiness. Daily time frames are the most psychologically significant time frames. Folks look at the end of day close to determine if something is up or down, which doesn't mean daily time frames are always going to be the best time frame to trade, but they're always going to reflect the broadest view of bullishness or bearishness of that market sentiment. And then by slowing things down, we can start to realize that certain types of orders are going to encourage over trading, market orders, and certain types of orders are going to prioritize precision on a particular price and slowness, right? And that's going to be limit orders for entries and targets, and use alerts for everything, right? I seldom hit the market order. If I'm hitting market order, something's gone wrong in the trading plan. I did not see the trade coming. I did not prepare properly, whatever it is. I can't remember the last time I've done it. I don't hit the market order button. Use limit orders to get in the long calls, use limit orders at the targets, and then use stop orders, which is another kind of price conditional order, to get out. All right. What are metrics that matter? And this is going to matter a lot because as we're using these guidelines, these principles to navigate 2025 and every year that comes after, there are certain metrics that matter. Risk to account per trade. What is the worst case scenario lost in the account per trade? Most traders will function perfectly fine and wonder why their account doesn't grow, or worse, why they blow up their account, because they'll normally risk 10+% of their account per trade, right? That's very normal. If you think about the number of people who talk about blowing up their accounts, believe me, the first thing that they're probably not looking at is how much risk to the account are they presenting per trade. By the way, I can say this with a certain amount of confidence that if you look at that metric first, you will make it very hard to blow up an account. I've never blown up an account, gang. Doesn't mean that I haven't had losing trades, but I've never blown up an account because risk to account per trade is one of the first things I think about. Here's another one that folks don't think about enough. Risk to target. It is very commonplace in this world of no account growth and blowing up accounts. Let's face it, 90% of traders lose because they're overlooking certain metrics. If we put a trade in, I'm going to give you all a great example. We put a trade in in TSLL the other day. All right. It ended up losing. It was a losing trade. The risk to the account was less than 1.6% of the overall account size. The risk per contract was 15%. If I hit my target, and some of our traders did, they took 25% of premium paid off the table. And if a trade can continue, it's very likely going to be much, much more. Here's what losing traders do. They add to losers. And the other thing that they'll do is that, and by the way, ADD is an acronym for actual delusion and denial. Risk to target means that I'm going to buy at whatever level. And then when the trade goes against me, I'm going to buy again and buy again and buy again. This is adding, hoping that I can reduce the cost basis to low enough a number that if we get the slightest bit of a bounce, I can make some profit. Commonly, those traders will be risking 50, 60, 80% of premium paid to do what? To make 20%, 30%? If you're risking 80% of premium paid, the goal better be 80% premium paid. That's a 1-to-1 risk reward. If you're habitually risking 50% of premium paid, and plenty of traders do, your initial expectation, a realistic expectation for reward, better also be 50%. This is where, again, a lot of traders are just not using the metrics that matter to help their account growth. And really, I should make this one the first one. The only metric that matters is consistent account growth. I've had negative months. I'm going to walk you all through a negative month from 2024 in upcoming weeks. That negative month, by the way, was April. But I've never not grown an account year to year. Sometimes it's very small amounts of growth. Other times it's in the triple, and a few times in my career, the quadruple digits, right? But every year the goal is to have more in your account on December 31st than you had January 1. And I don't care if it's $500. If you're able to manage that, that's a positive year, and you're probably learning along the way, okay? The last two metrics that matter are the average winner and the average loser. Not here are my three biggest winners and never discuss losers. By the way, that's exactly what most traders do. They celebrate their winners. They only talk about their winners when it's really the losers that are keeping them from the most important metric, which is account growth. All right, so think about these. Now, Amazon's an interesting example. When Amazon was trending higher, this was a great trade. We were risking approximately 25% on premium paid, and the ultimate return, I think on the very last scale out, was north of 300%. I'm not going to talk about percentage gains. We're going to talk about how many dollars did we spend versus how many dollars did we make. These options cost on average between $5.5 and $7.5. And then ultimately we're scaling out north of $25. We talk in the language of dollars or points per contract, right? Not percentage gains. Win rate is another incomplete statistic, right? And win rate really is only relevant if the average loser and the average winner and the risk to the account per trade and the risk to target is discussed. You can have a 60, 70% win rate and still not grow the account if your average loser or your largest losers are bigger than your average winners or your largest winners. So remember, these are incomplete statistics, and sadly, these are the most common. Let's get the year off on the right foot by remembering we want to focus on trends, we want to focus on watch list building, and we want to focus on those metrics that matter. Okay, think about where the trends are right now. Think about where the trends aren't right now. And mostly we're going to find that this is going to be a stock pickers, very likely a stock pickers quarter, where we're going to have to find the sectors that are at least bullish to neutral and then find the individual stocks that are outperforming. And, there are a handful of them. We'll talk more about that in the premium video.